Hello everyone, welcome to the session. I'm Egle Karmaziene from Vrije Universiteit Amsterdam, and today we'll present a joint paper with Dannhauser. And we call this paper Corporate Bond ETFs and Volatility. So differently from a previous paper, here we look only at the corporate bond market. While only some ETFs cover bonds, it is a very large market. In the US, over 41 trillion US dollars are issued. In the US, the corporate bond market constitutes about $41 trillion. And typically, companies raise more money issuing bonds than stocks. However, unfortunately, this is a very illiquid market. Most of the bonds are traded only immediately after the bonds are issued, and there is basically no trading for the rest of the time until the bond matures. So the large majority of bonds do not trade every single day. However, ETFs come here and they facilitate trading, and ETFs allow even retail investors to access bond market, access fixed income market, and at very low costs. So, as the previous presenter presented, ETFs are just baskets of securities that allow trading of multiple stocks at the same time. And while it is very similar in the equities market, trading stocks and ETFs, so they look like substitutes. With bonds, it's a little bit different because bonds are traded over the counter in a very illiquid market, whereas ETFs are traded on a very liquid exchange. And the movement from trading illiquid bonds to liquid bond ETFs is very sudden. So even the Financial Times reports that ETFs are now eating the bond market because they are becoming major players in the bond market. And the retail investors and other investors picked up the pace and they started using the ETFs. And the value of ETFs has been rising dramatically over the last years. However, we do not know much how being a member of ETFs affects the underlying bonds. Does it stabilize or destabilize the underlying security? And this is exactly what we are going to do in this paper. We look whether ETF ownership affects corporate bond return volatility, right? And in particular, we'll also look at what mechanisms are responsible for the effect. Our main findings are the following. So we show that the ETF ownership reduces bond return volatility, and the effect comes primarily from the secondary market trading. Okay, so the ETFs link two very different markets, the illiquid over-the-counter bond market and liquid equity exchange. Okay, and there are two key features in bond ETFs, the secondary market and primary market. Secondary market is the market where ETFs are traded without touching the underlying securities. So you have one ETF and you trade it with someone on the exchange without touching the underlying securities. Whereas the primary market helps to create and redeem the ETFs using the underlying security. So what we think, or what our hypothesis is, that this secondary market trading allows the investors to get exposure to the bond market without touching underlying, and therefore it should not increase the volatility of underlying securities. While the primary market could affect the underlying securities and transmit the shocks into the primary market. Okay? So these features can either buffer or transmit the shocks into the underlying securities. Okay? So I don't have much time. I just want to say that we position ourselves in terms of different academic studies in line with academic studies, and we focus mainly on the effects of ETFs on the underlying securities. So far, most of the studies have been done on the equity markets and equity ETFs. Here we add to the studies on bond ETFs. So we use 7 years of data, and we look at over 8,000 bonds issued by over 1,000 of companies. and 263 bond ETFs. And we use classic sources of data that are used in ETF literature and bond literature. So here we want to look at the relationship between ETF ownership and bond volatility. So we use this measure of bond volatility, which is the standard deviation of returns. We focus only on bonds that are traded at least 10 trading days over the month. And we define returns as the difference, as the price, as the value-weighted transaction price of bond over its value at T-1. Okay? So for the ETF,
I'm worried about selection issues if you don't include the bonds that didn't trade, because those prices will be flat.
Yeah.
Zero.
So we exclude these bonds. So we focus only on the bonds that are traded, but we require only half of trading days per month. So on average, these bonds are traded more than the average bonds, but still we have to decide on which ones to include and still get the volatility measures.
If there is no trading on a specific day, will you take the last day?
Yeah, but we focus only on the bonds that are traded at least 10 days per month.
On other days, will you take the previous days?
No, so if they are not traded, we're not taking the previous days.
So you take a bond only 10 days a month?
Yes. Okay, for the ETF ownership, we calculate the fraction of bonds that are held by all ETFs that are there. Okay, so how do bonds look in our sample? So on average, bonds are 4% of bond ownership comes from ETFs, 2% from index mutual funds, and 9% of active mutual funds. So while the ETF ownership is not that large, it is significant in comparison to the other type of institutional owners. Okay, so what we do here is we regress the volatility of bond returns on ETF ownership, right? And basically we want to know whether ETF ownership this month affects the volatility of bond returns the next month, the following month, right? And we add multiple controls to this regression, such as bond size, bond age, and illiquidity measures. And in addition, we add issuer by month fixed effects. Thereby, we eliminate all variation that is at the, we eliminate all factors affecting the issuer or the company that issues the bonds, and we compare two bonds issued by the same company. One has high ETF ownership, the other has lower ETF ownership, and we observe how the volatility of these bonds differ. Okay, so we capture all variation at the company month level. Yes, please. Yeah.
When you define the volatility of the return, it's probably given one. Yes. If your observations on the returns are not daily, but only 10 days a month,
yeah.
So there will be periods when the return is over 1 day, and there is another period when the return will be over 5 days.
Yeah.
So how can you put them together with one formula of a standard deviation?
So we focus only on bonds that have at least 10 trading days per month.
These 10 trading days can be distributed in a non-uniform way.
Yes.
So sometimes it will be one.
So only when we have 10
Tuesday,
returns. When we have 10 returns.
But they are over different time periods.
Maybe I can clarify. So if those 10 days were just the 10 days in the middle of the month, that's a different situation when the 10 days were spread out over the month.
It is.
That's the point.
We do not account for that.
Yeah, but if one return over 1 day and the second return is over a period of a week, you just put them together and calculate standard deviation?
No, we calculate return when we have 2 consecutive days, right?
Only consecutive
We have,
days?
2 consecutive trading days. If it's Monday and Friday, that's fine.
What do you mean Friday?
Friday to Monday.
Friday.
But
Over the weekend,
there
that's fine.
is a distance between them, you have to normalize it.
The distance between Monday and Friday.
Time.
Yes.
Do you do it?
No, we do not. So if there is Monday and Friday, we treat them as 2 consecutive days.
But the return is always 2 consecutive days.
2 consecutive trading days.
Yes.
Right?
Which is different from 2 consecutive days.
Yeah.
So it's not the same volatility.
That's true, but since there is less news on the weekends,
Maybe there were news, there were a lot of trade. How do you know?
no.
Assume that there
Could we discuss it a little bit later?
First day of the month and the last day, and another bond was traded on the first day of the month and the second day of the month.
We keep only if we have 10 returns.
Yeah.
So at least half of the trading days. Could we move a discussion? Could we move a discussion a little bit?
For you in your regression, you can add a dummy for over month spanning return or over weekends. You can add just dummy.
I could do that. Yeah, I could
That's a
also,
simple
yeah.
thing, and it will address it.
Yeah, I could also account for the number of trading days per month, right?
Exactly.
In the
Yeah.
regression. Okay, and the results are the following. So what we find is that the ETF ownership decreases volatility of the underlying securities. And the effect is strong. If you can see that we have 3 stars here, and it is robust to including different fixed effects like type of a bond, issuer, rating, type, date, like fixed effect. So we have lots of different controls, but the effect is robust, and which means that a 1 percentage point in increase in ETF ownership reduces the bond volatility by about 5% of its standard deviation. So while the effect is relatively small, it is important for 2 reasons. First of all, the bond return volatility is relatively lower compared to the stocks, so even small deviations matter. Also, the effect is opposite in equities. So in equities market, the ETF ownership increases the volatility of the underlying securities because they start co-moving more. Here we show that the effect is negative. Okay, and we also are able to show that the effect is even more negative for the bonds that are illiquid, infrequently traded, or have a small issuance size. So for the bonds that are less liquid, the effect is stronger. Okay, so you may think that the ETF ownership may be endogenous, right? So ETFs may select the bonds that have lower volatility, they have less risk, right? So to account for that, what we do, we use a natural experiment in which one of the largest ETFs chose a different index to follow. So before it followed an index and included bonds that have 1 to 3 years to maturity, now they expand this horizon and include bonds for 1 to 5 years to maturity. So we have a sudden shift and a sudden increase in demand by ETFs for the bonds that are 3 to 5 years to maturity, right? So in this graph, what we do, we compare the trends or how the ETF ownership looked before this natural experiment and after. And what we see that while before the trends in ETF ownership were parallel, they differ in the later part. So the treatment bonds, the bonds that are 3 to 5 years to maturity, have a sudden increase in ETF ownership. And at the same time, we see that there is a difference between treatment and control group volatility of returns. So we formalize this experiment, and we see that indeed, post-treatment, the ETF ownership increases for affected bonds and volatility decreases. So this experiment validates our identification and confirms a causal link. So in bond market or fixed income market, the ETF ownership lowers the volatility of bond returns. Okay, now I would like you to stay with me and unpack the mechanisms for this effect. Okay, so let me show you this graph which plots the secondary market activity, or the total trading volume of different ETFs. And here I plot all ETFs in our sample, which is 265 ETFs in total. And what you can see, the top 3 ETF constitute over half of total trading volume. So there is a lot of concentration in bond ETF market. And this graph depicts that ETF trading volume is very concentrated in these top 3, right? Okay, so that's one thing. Another graph that I want to show you, these are the 14 most traded ETFs. The black bars show that their trading volume in $1 billion, and the blue bars depict the assets under management, right? Or how big they are. And what we see if we compare, let's say, the second and the fourth one, which are very large and well-traded ETFs, is that this one has this one, LQD, has almost 3 times lower assets under management, but is about 3 times traded more than this one. So ETF ownership doesn't mean high secondary market activity. So it is very important to unpack these two effects. Okay? So what we do is we investigate whether ownership by the 3, 5, or 10 most traded ETFs leads to different bond volatility. And what we see, indeed, the effect is different. And having a larger weight in the most liquid ETFs decreases the the bond volatility even more, okay? So the secondary market activity, or how frequently the ETFs are traded, affects the bond volatility even more. Okay, the last thing that I want to show you is this graph. In this graph shows the weights. This graph shows that, for example, if you want to create a stock ETF like S&P 500 stock, you have to give 500 underlying stocks to the authorized participant, right? And only then you can create additional unit of ETFs. If we look at the bond market, it is enough to have 3 or 5% of the underlying securities to create a new ETF, right? So here, there is a very large difference on the number of securities that you use when creating additional units. So the fact that this bond has very high ETF ownership doesn't mean that it will be used in the primary market activity once new ETFs will be created, right? So we need to disentangle here effects of ETF ownership and usage of these bonds in the primary market activity. So using daily data of ETF holdings, we create a new measure of primary market activity, which captures how much of this bond was used when creating new units of ETFs. And we interact this ETF primary market activity with ETF ownership, and we show that the effect is positive. That is, the bond returns increase when there is more primary market activity, right? So, in this paper, we show that the ETF ownership decreases bond return volatility. The link is causal, and the effect comes from the secondary market activity, right? That's it. Thank you.